Hey folks, it's Simon here with your Tao Daily for the market close as of Thursday, the 3rd of April, 2025. Yesterday's video, we talked about how the test and reject for a number of indices and stocks would ordinarily be bullish, okay, but for the aftermarket announcement of tariffs at the so-called Rose Garden speech for Liberation Day, and the market has taken that very negatively. All right, the depth and breadth of the tariffs proved to be a significant negative surprise for markets, with Trump implementing tariffs across 185 countries simultaneously. So in response to that, the S&P 500 has erased nearly $3 trillion worth of value in the last 24 hours. If we look at the NASDAQ, that suffered its greatest ever points drop in history. And if we look at the Russell 2000, which IWM tracks, that closed in bear market territory for the first time since 2022. Okay, so to say that the markets are not thrilled about the implementation of these tariffs would be an understatement. What we're seeing is it's not quite global liquidation, but it is bordering on it. If we look at Europe, SX5E, we can look at Europe as down 3.6%. If we look at Japan, we can look at EWJ, the MSCI Japan ETF, that was down over 4%. Emerging markets did somewhat better. If we look at sort of Chinese proxies, like the 2822 ETF listed in Hong Kong, that was barely down at all. If we look at Brazil, EWZ, that was actually positive on the day. If we look at India, that was down 0.74%, no big deal there. If we look at the UK, that was down less than 1%. All right, so not all markets got scathed, but certainly the US, Europe, and Japan certainly got caught up in it. In commodities, we had some pretty big falls as well. Oil had a big spill. Look at that candle, down over 6%, 6.5%. If we look at silver futures having a similar spill. This is just risk liquidation here. Silver down nearly 8%. Gold held up relatively well, but we do have a bearish engulfing candle there in gold. That looks like it's probably due for at least a reversion to the mean from here. This all just smells like margin calls, margin selling. Bonds were one of the very few highlights. TLT, using that as a bond proxy, was up nearly 0.5%. Interestingly here, the dollar is getting smoked. The dollar had a strong down day. It was down 1.7%. I wrote a thread on why we're seeing a weak dollar. Usually when we're in a risk-off environment, people flock to the dollar. In this case, that is not happening. There's a number of reasons for it. Chiefly, I think it's because the source of risk is the US itself. All right, but we've got US twin deficits. We've got policies, got inflationary concerns. The world is slowly and quietly de-dollarizing, and we've got a repricing of US rate expectations. So if you're on X or Twitter, check out that thread. Certainly, this is an unusual set of circumstances. In terms of things to do, look, I mean, it kind of, everybody feels bearish and, it feels like things can only go lower. The problem is, yeah, I agree things are bearish, but when things are bearish and quote unquote oversold, it doesn't make a lot of sense trying to short in a hole. Because when markets get oversold, like they are at the moment, they have this funny tendency to find a low and bounce. All right, so it's not to say that we bounce tomorrow, but we're probably not far away from a bounce, and shorting in the hole, it might feel like the right thing to do, but it really is the right thing to do. Can the market fall much further from here? Well, let's just have a look at some projections. So if we take Fibonacci projection tool and just project from that swing high, we're getting downside targets of sort of 51.44. That might sound outlandish, but that would be a fairly normal measured move. That just all that means is this move from this high to this low would be the same size as the move from that high to that low. So there'll be an impulsive move to the downside. Now, what could get us there? Well, just a simple derating in equities, all right? If we look at this chart from Goldman, this was published yesterday, Goldman's baseline earnings estimate is for 3% earnings growth in 2025. Now, if the price earnings ratio on stocks derates to just 20 times, all right, which is still not cheap, all right? that would bring the S&P down to 50.50. If we get back to the 10-year average PE of 18 times, that would get us back to 45.50, which is another 15-16% drop from where we are now. Normally, for a bear market, you need a recession, you need an earnings contraction. And if earnings contract, then, downside targets become much, much lower. You could easily see the S&P with a 3 handle. So the prognosis is not super bullish here, but you've got to not confuse the cyclical with the structural. And we could be close to a cyclical low here, just looking at how stretched to the downside the market is right now. That's what I got for you. I hope it helps, and I'll catch you tomorrow. Thank you.